Hi, I'm Jesse Jones, founder of Fourscore Business Law. Thanks for tuning in to this quick video on how to structure an equity deal. The first thing you need to know when you're bringing an investor in and selling them shares of your company is that you're basically entering into a marriage. Once that investor puts their money in and the company issues them the shares, they are going to be with you until the end. So make sure that you choose wisely when you're choosing your investors. We're going to go over just two things in this video about equity deals. Number one, we want to talk a little bit about the difference between preferred stock and common stock. Now, in almost all angel and venture financing deals, you're going to find that investors want to purchase preferred stock. Now, what is the difference? So founders have common stock. You and your co-founder started the company, you were issued shares of common stock. Preferred stock is ownership, just like common stock is, but there are additional rights or preferences, which is why it's called preferred stock, that come along with the purchase of preferred stock. So most likely your investor is going to ask for preferred stock. That's not a bad thing, that's very normal, that's very standard, but there is a difference and you should know the difference, and we're going to get into the differences here. Before we do that though, one major point of negotiation in every preferred stock equity deal is going to be the valuation of the company. Now, entrepreneurs tend to want to push that value as high as they possibly can, and you would think investors want to push that value as low as they possibly can. And in most cases, that really is the case. But if you're an entrepreneur, you need to keep in mind what is your exit plan. And what you want to show over time is steady growth, right, up and to the right of the valuation of your company. And so you actually can shoot yourself in the foot if you negotiate for a super high value at the very beginning, because the next time investors come in, that may have to get adjusted. If it gets adjusted down, it becomes more complicated, it doesn't look quite as good. So you always need to keep in mind what your exit plan is. Who are your potential acquirers, 3, 4, 5, 6, 7 years down the road. It's very important. You got to think about the end when you're at the beginning. And so valuation, although it's very important, and you want it to be high, you also want it to be a solid valuation that you're going to be able to grow off of. For more information on venture financing, please check out the venture white paper at fourscorelaw.com. Thanks.